The New York Stock Exchange is currently closed for the weekend. Nokia last traded on Friday, June 12, 2026 at 4:04 p.m. Eastern Time, closing at exactly $14.80 per share. This capped off a remarkable intraday surge of 5.04%, with the stock climbing 71 cents on massive trading volume that reached over 117 million shares. While a typical retail investor looking at Nokia might view it as an old-school telecom giant that moves like molasses, the actual reality behind this Friday spike completely defies that narrative. Wall Street experienced a massive shockwave when JP Morgan completely shifted its stance on Nokia, raising its price target to $21 per share from its previous $14, implying a massive 50% upside from current levels. The driving force here is not cellular towers or European telecom contracts. It is a staggering €1 billion in fresh cloud and artificial intelligence infrastructure orders that have flooded into Nokia's books. The market completely missed how quietly this company has positioned itself as an indispensable physical backbone for massive hyperscale data centers, forcing institutions to frantically cover their short positions and accumulate shares hand over fist in the final hours of the week. The general expectation surrounding Nokia has long been a story of stagnating legacy infrastructure. Most retail investors who browse standard investing sites or look at basic ticker feeds view the company as a relic of the early mobile phone days that eventually morphed into a low-margin 5G hardware vendor. The broad consensus was that Nokia would forever be stuck waiting for slow telecom carriers to upgrade their wireless networks, making the stock a boring, range-bound choice for capital preservation rather than explosive growth. The real story, however, breaks that assumption entirely. The reality is Nokia owns and operates its own specialized indium phosphide semiconductor fabrication facilities and advanced optoelectronic packaging plants. This specific in-house industrial capacity allows them to build high-performance optical switches and routing systems that handle the massive data throughput required by modern clusters. While retail traders are busy chasing high-flying graphics chip makers, the massive physical bottleneck in the technology sector has silently shifted to the physical fiber optic networks that connect those chips across data centers. JP Morgan's analysts openly admitted that the wider financial community completely left out this massive revenue stream from their financial models, setting up a situation where the structural reality of Nokia's business is vastly outpacing what the market believed just days ago. This structural disconnect becomes even clearer when you look at the recent trading data and options activity from Friday's session. The options market saw an absolutely massive surge in interest, with over 572,000 contracts changing hands in a single day, pushing total open interest to more than 4.2 million active contracts. That is nearly 120% of the normal 30-day average trading volume for their derivative products. Interestingly, call options dominated the tape, making up roughly 75% of the total transactions, showing a massive institutional bias towards the upside. This heavy buying pressure forced a classic gamma squeeze scenario during intraday trading, as market makers who sold those call options were forced to buy millions of shares of underlying stock to hedge their risk as Nokia pushed past key technical resistance levels. This high-volume breakout occurred while broader sector indicators remained relatively flat, proving that money is actively migrating out of speculative companies and seeking refuge in businesses that possess hard, tangible revenue and unique manufacturing capacity. Large funds using a sophisticated interactive brokers platform or executing large block trades through a premium fidelity trading platform have clearly recognized that Nokia represents an overlooked pocket of value in an otherwise overextended market. If you are managing an individual brokerage account or picking your own assets using popular retail applications like the Robinhood app or via basic self-investing methods, it is incredibly easy to overlook the macro factors at play here. For months, the primary headwind for legacy networking companies was high global interest rates and a major slowdown in regional 5G rollouts, particularly across massive markets like India and North America, where capital expenditure budgets were slashed by major carriers. This slowdown initially caused Nokia to report mixed financial numbers earlier in the year, where total revenue of €4.49 billion came in lower than what the street wanted to see. But while headline revenue soft-pedaled the company's progress, their adjusted earnings per share actually beat expectations, coming in at 5 cents per euro compared to the 4-cent consensus estimate. This internal resilience was achieved through aggressive internal cost-cutting, restructuring of their mobile infrastructure divisions, and optimization of supply chains. It showed that even when the outside world was rough, the business was actively cleaning up its house to maximize future profits. Comment below how many shares of Nokia stock you currently hold, or if you are considering adding it to your portfolio after this major structural shift. To fully grasp why this expectation versus reality dynamic is creating such a volatile setup for the stock, we need to look at what Nokia actually does today versus its historical business model. After selling off its consumer mobile phone division over a decade ago, Nokia re-engineered itself into a pure-play networking equipment provider. The core of the company is split between mobile networks, cloud and network services, and network infrastructure. It is this last division, network infrastructure, that is currently undergoing an immense structural shift. This segment deals with IP routing, optical networks, and submarine cable systems that form the actual plumbing of the modern internet. Their business model relies on large-scale hardware sales paired with long-term high-margin software licensing and maintenance agreements. Historically, this meant their fortunes were entirely tied to cyclical corporate spend from major telecom giants. But by shifting their target market directly towards massive web-scale tech firms and cloud operators, Nokia has managed to tap into a completely different, faster-growing pool of capital expenditures. This structural shift is transforming them from a slow-moving utility supplier into a vital infrastructure provider for high-density computing clusters. Looking at the older financial data from late last year and early 2026, management had originally set their long-term operating profit expectations between 2.7 and 3.2 billion euros by 2028. However, those old projections completely left out the massive wave of optical switch design wins that Nokia has secured in recent months. Because these newer data systems require insane amounts of bandwidth to prevent data latency, conventional copper connections are being entirely replaced with advanced optical networking equipment. Since Nokia controls its own component manufacturing, they do not suffer from the same third-party chip shortages that plague smaller competitors. This secure supply chain gives them a massive edge when bidding on massive multi-million-dollar data center deployments. Consequently, independent research firms like Morningstar are now explicitly pointing out that demand from massive cloud hyperscalers will likely serve as the dominant revenue driver for Nokia over the next 3 to 5 years, completely overshadowing the slow growth seen in their traditional mobile cellular division. For anyone managing an individual portfolio or utilizing modern digital wealth management services, understanding the forward-looking risks and opportunities is what separates successful long-term investing from pure gambling. Going forward, there are two distinct paths that could play out for Nokia stock over the next 12 to 18 months. In the bullish scenario, the massive acceleration in optical network orders continues to compound, causing actual revenues to completely outrun current consensus models. As these high-margin software and hardware packages ship out, Nokia's operating margins could expand dramatically, driving a sustained re-rating of the stock's valuation multiple. Since the company currently trades at a significantly lower valuation relative to its pure-play American networking competitors, a successful expansion into cloud data centers could easily bridge that valuation gap, helping the stock chase down JP Morgan's aggressive $21 price target. Furthermore, as large institutional exchange-traded funds and mutual funds rebalance their holdings to include companies with real commercial enterprise applications, a steady stream of passive capital will likely keep buying up shares, creating a solid floor underneath the stock's price during market downturns. On the other hand, the bearish scenario cannot be ignored by anyone engaging in online investing. The primary risk centers on execution and global macroeconomic stability. If global corporate spending slows down due to broader economic pressures, even large cloud hyperscalers might push back their infrastructure buildouts, slowing down Nokia's order conversion rate. Additionally, while Nokia has done a great job optimizing its cost structure, its traditional mobile networks division still faces intense competition from global rivals, which can lead to aggressive price wars and margin compression in regional wireless contracts. There is also the risk of technological obsolescence if a competitor introduces a radically different network architecture that bypasses the need for Nokia's specific optical designs. Investors tracking this asset through advanced online investment portals or tracking automated allocations through an intelligent portfolio platform need to closely watch the upcoming quarterly financial statements to verify if that €1 billion order pipeline is translating into actual realized cash flow, or if it remains stuck as unfulfilled backlog. When you look at how this entire situation sits at the intersection of investor expectations and corporate reality, it becomes clear why Nokia is experiencing such an aggressive revival. The market spent years writing this company off as a stagnant telecom stock that was irrelevant to the broader technology landscape. That low expectation created an incredibly depressed valuation, leaving the stock completely uncovered by major institutional growth funds. But the reality of their specialized manufacturing assets, coupled with a massive influx of cloud enterprise orders, has created a sharp upward correction that is catching short sellers and legacy asset managers completely off guard. By outperforming expectations exactly where it matters most, Nokia has fundamentally changed the conversation around its long-term financial path. It is no longer a question of whether wireless carriers will buy more cellular towers. It is a question of how quickly Nokia can scale its production facilities to meet the massive demand of the modern internet infrastructure. For any serious participant in self-investing or professional portfolio management, tracking this divergence between old assumptions and new structural fundamentals will be absolutely critical as the corporate landscape continues to reorganize itself around high-performance computing needs. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.